Hey, what's going on YouTube? Kenny here, and today we are going to do something that I think is going to be very productive given the kind of price action that's happening in the past couple of days. So what we're looking at here is obviously the S&P 500. We're going to do a technical analysis on S&P 500, kind of give you my thoughts, kind of put some qualitative assessment against it, not just in a vacuum here, and just kind of think about, fundamentally and macro-wise, what could happen, what should happen, and give you the Redcliffe Research price target for year's end. So again, here is kind of the S&P 500 in the previous trend that we drew. So the way we draw these regression channels are the mathematical average. It's not just lines going from left to right, these arbitrary lines that are kind of drawing out a pattern. So here's the break of this regression channel and break towards the downside. So as you can see here, obviously here from the last bounce, which was where we generally draw these channels, it has broken. So, we broke a couple times here, but this is definitely the biggest slip that you've seen. So obviously, volatility is back for one, but the second piece is, again, the trend is broken. So what does that mean? I'm going to walk the dog a little bit, and I think this is kind of an interesting kind of thought experiment. So just kind of enjoy the ride, because here we go. So if no rejection, new trends can start on the same side as well. So, just because it rejects or whatever like that, if it does come down, you say, oh, okay, the trend has kind of broken. When it breaks to the upside, though, it doesn't always mean, even though it's statistically significant, and this is an arbitrary trend line. I'm just showing you that because a lot of technicians, amateur technicians probably would say that this is something that they've been watching. A lot of people have been watching this kind of toppy kind of price action, but they were riding it, I think, from over here is kind of the consensus, and it's still showing like a boiling top up here. But my point here is that, given what we see, it doesn't have to be a downtrend. It can be another uptrend, right? So bucking this kind of regression channel here, this is not a regression channel, obviously, but say, for instance, this is a 75% year-over-year channel. This is a new channel, and this channel is indeed a little bit more than that. And I think this is like a 35% channel, actually, not 75%. So, okay, so if we draw the regression channel again from here, right? You can see this is from 2008 again, kind of clearing it and going up to the upside. So if you start it from the new trend, so back here we were talking about right here, right here, this piece right here, right? So if you start this regression from March, what we find is that new trend from here looks like this, right? And even this new trend right now is still broken, right? So we're still breaking that new trend, and it's hitting the 100-day moving average. So I want to take a qualitative argument right now. So most firms have a price target of around 460, and they think that's going to rally into the year's end, 2021. But again, here's 460 right here, this little line up here, and we've definitely slipped below it. As is, we would have hit 460 by October, but obviously folks have kind of baked some kind of a correction in. So I think, standard kind of thought was, if it's hitting the 50-day moving average or somewhere in between, kind of not slipping through the 100, we can play around in here and definitely get there by year's end, 460, and probably kind of reject back to 460 going into January. That said, I'm not so constructive on 460, and I'll show you why. So the recovery trend line here from the pandemic lows is actually an 85% year-over-year return channel. So if you take, again, the regression channel, which is the mathematical average of this channel going up, from March, if this consistently persists, it's 85%. So meaning that if this keeps going by 2023, you're up here, up into 600 land already. So is that reasonable? Is that feasible? Likely not. So again, let me walk the dog for you here. So, okay, using the same 85% trend line or regression channel, it must bounce exactly now. And again, see this green line? This green line is that 85% line. So it's representing a year-over-year annual growth rate of 85%, right? So all I did was I took it from here, from this middle line, and I pulled it down, right? So I pulled it down to where we're at right now, and this is where we're at right now, 429. And so if it holds by December 21st right here, this line right here, it will get to 460. So if you think 460 is going to happen, it needs to happen right now. It could slip a little bit more, but it'd have to rally really hard. So you should be in dip buying mode if you think so. I'm in a different camp, and so I'll show you what I think. But is it reasonable given? So actually, kind of the thing that I need to ask you, like, is it reasonable given the interest rates and bond prices that could happen? And is it reasonable with the kind of taper talk that is coming up, right? So we know tapering is coming, and is that kind of feasible, reasonable? I would kind of argue not, right? So kind of my point to this is I don't know that 460 happens, and I think we probably go kind of flat from here. And so by comparison, in 2008, the recovery channel here, this is obviously from a real actual fundamental correction in the economy, but the 2008 recovery was 33%, right? And that's what that channel looks like, just as a comparison. What else? So if you want to take a look at the Demark indicator, this is the S&P 500 again, but obviously here we printed a 9, and it's not constructive. We're still early in the count, so we're only on a 2 or 3 count, and we know we can slip down to 9, which would probably hit around 400, if we do it slowly. Or, we could hit a 13, which would be kind of catastrophic for most people's portfolios, but, that's kind of what the stock market is and what the stock market does, right? Am I calling for kind of a top here? I don't think so. I think we'll get a bounce. I just don't think we'll get a bounce right now. Honestly, I think October is going to be very, very bearish. A lot of indicators, a lot of folks, and a lot of just money doesn't seem to really want to flee to safety into the stock market, rather other places for safety for their money. So how big will this correction be? Well, if we touch the 200, we will get 9.12%, right? And that's not even the average correction size. And given how kind of awesome this channel is, an 85% channel, you would expect more volatility if things haven't changed, and if you don't think like some of the macro or fundamental things of the stock market has changed yet. If so, and if things, if history repeats itself, then an 85% move should be a far more volatile move than 10%. Obviously, any more than 10% is crash territory, so that's kind of obviously disturbing for most folks. But I would expect something a little bit more than 10% or a little bit of a slip. So if it indeed does 10%. What would happen is, it would slip under the 200. This would be all October, trying to work its way down, slips under the 200, and then we rally into Christmas, and we kind of peel on that Santa Claus rally, and we think that 433 just kind of going flat from here, right? If we kind of go back to the previous side. And I swear I've had a slide in here for it, but you get my point. Basically, we peel here, and then we rally into year's end, 433. I'm not sure where that slide went. Apologies. If you're new to this channel, we do everything kind of in one take. So, yeah. So one other chart that I wanted to take a look at here is kind of, and I pulled this straight from CNBC. I've been watching this as well, but there's definitely a divergence now. So Tesla in yellow going up, and ARKK in white going down, which is super interesting. And the reason I'm bringing this up is, kind of some criticisms of investing and kind of portfolio management and portfolio building and all this other stuff. There's a certain point where there's mass dilution of kind of your portfolio where there's different types of philosophies, but one that we prescribe to is just you're not a fund. You don't have to sit there and kind of disperse your funds into just so many different pockets where you start bleeding out in all the different pockets, because essentially it's really hard to find great companies. So why invest in companies that you don't think are great just because you have to find a bucket? So obviously ARK has to bucket their kind of equities into different bins, and they have to kind of manage their risk and their beta and everything like that. But from our view, from retail investors kind of seat, and where you sit and where I sit, we don't need to be doing that, so don't do that. So like if you really like Tesla, just buy Tesla, don't buy ARKK, right? And this is one of those ones where like, you know, it was moving kind of in tandem, but like I'm just saying, like, you know, you're gonna outsmart her on just by buying Tesla is all I'm saying. This is not a knock at the fund or knock at any of that stuff, because maybe it will outperform after this, but it's highly unlikely because it's just so diluted. And so, you know, if you're going to bet on a really fast horse, bet on a really fast horse. The whole innovation appeal is probably kind of a stale afterthought at this point, and it's probably going to miss the mark at this point. We'll see. I could be absolutely wrong, but just kind of my thoughts. And the idea here is not to knock anybody or do any of that stuff, but it's really just create your own theory, create your own thesis, and if things change, to change with it, right? To not be kind of stale and not be static, because that's the thing that will kind of really be very deconstructive for your portfolio and kind of your balance sheet, if you will. But yeah, that's really it. Thanks for watching. Just a really quick update in S&P, and so we'll probably see you tomorrow or Saturday. Thanks for watching, and see you. Bye.